Today, is deposit bail-in a thing in Australia? Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and problem news with a distinctively Australian flavour. Well, I get a lot of queries from my shows, but there are two that really stand out. The first relates to the trajectory of house prices, and I've covered that in several shows recently. I think prices will fall further because of interest rate rises and the availability of credit getting tight. But the other one which comes up very often is deposit bail-in. So today I just want to take you through the key thoughts with regards to bail-in in Australia. And I should just caveat this by saying this is not legal advice, this is just my general opinion relating to the question of deposit bail-in. If you want more specific information, go talk to your bank or go talk to a lawyer. Let me just start with the definition. Deposit bail-in is a thing that was developed post the global financial crisis through the G20 and thanks to some investment bankers, which suggested that rather than, in a case of bank failure, a government bailing them out, the deposits at the bank should be converted to equity to allow the bank to continue. In other words, it doesn't fail as a result of that. And because a deposit is effectively an unsecured loan to a bank, it means that you essentially change that into equity. And whilst there have been a few examples around the world where banks have been bailed out, there have been examples of bail-in, particularly, for example, in Greece. And there we saw that in some cases that equity did actually continue to pay value back to the consumer. Of course, they couldn't get access to the deposits. But elsewhere, the bank still failed, and so that deposit money, which was converted to equity, got reduced to zero in terms of value. So in other words, you could, theoretically, in a bail-in situation, lose the equity and therefore lose your deposit indirectly. Now, in Australia, the situation is extremely unclear. Unlike New Zealand, New Zealand actually introduced a particular scheme, the Open Banking Resolution, that still exists in New Zealand, and there they made it very transparent that they could bail in deposits to save a bank. There's a website, there are some little charts that show how it could work in theory. And also in New Zealand, the Reserve Bank in New Zealand has a scorecard for each bank because they believe it's important for depositors to weigh up the risks of different banks as to which ones may or may not be more risky and therefore more at risk of bail-in later. And by the way, given the situation in New Zealand at the moment, that's probably worth something for New Zealanders to consider. Where is your money the safest? But in Australia, it's much less clear. Now, a few years ago, there was the APRA Act brought in, which essentially gave APRA pretty much unlimited powers to deal with banks in crisis. And as part of that, there was a clause saying that they could essentially bail in, quote, any other instrument. Now, there was no direct reference to bank deposits, and APRA has consistently argued that any other instrument does not refer to deposits, and in fact deposits would never ever be bailed in Australia. However, there are some who think that the any other instrument is really a backdoor way of leaving things open to APRA such that in a crisis they might actually convert personal deposits into equity in a failing bank to stop it failing. Never been an example recently in Australia, although there was one many, many moons ago. And so this is just a theoretical risk at the moment. And in fact, there was an attempt a couple of years ago to table legislation to remove that clause, any other instrument. And a number of experts around the place said it's a no-brainer. You should just do it because it would actually take away that risk. So the situation is in Australia, we don't know. We don't know whether deposit bail-in is a thing, whether it could be activated. And in fact, if you ask politicians, they deflect. They refer to the deposit insurance scheme, which is designed to protect depositors when a bank has failed. Now, that is up to $250,000 at the moment per relationship per institution. Not all banks, of course, necessarily will be covered. You have to go and check on the APRA website. And if you have two banking relationships, for example, Westpac and St George, under the same banking license, then you're only counted up to $250,000 in total. But the point I want to make is that politicians keep referring to that arrangement, that's when a bank has failed, but won't talk about the bail-in risk with regard to bank deposits. So at the moment, the situation is quite unclear. And as I say, there has never been an example of a bank deposit bail-in in Australia. But given where we are now in the economic cycle with interest rates rising and with banks coming under pressure, it's worth trying to get more clarity. Now, a couple of other observations. There is this $250,000 protection limit on deposits. So one of the things that may be worth thinking about is keeping below the $250,000 at any one institution. That is because overseas, in some cases, the limit of bail-in was above the insured amount already in the system. But again, that's non-proven and unclear. The other question people ask is, well, what about superannuation funds? Well, superannuation funds are held by institutions and invested as trustees. They therefore do not fall into the standard deposit bail-in arrangement. And what about business accounts? Again, it's not clear, although it would perhaps be true to say that business accounts, if they've got savings, could potentially be bailed in. Certainly overseas that's the case. And the other question which people sometimes ask is about offset. In other words, if I've got a loan and I've got money sitting in an offset account, would the offset account money be bailed in, but will I still have the loan? And again, it's not clear, although I think the way to read this is that the right of offset would come first, so the bank would be required to effectively offset any loans and deposits before effectively going down the bail-in route. But let me make the point, the bank doesn't make the decision with regard to bail-in. The bank does not make the decision, APRA does. And one final point, coming back to those bank deposit schemes, they are not actually currently active. They have to be activated at the point when a bank goes bust. So you could see a scenario when APRA decides that a bank is in difficulty and triggers some sort of deposit bail-in ahead of alleviating a bank failure. And that would mean that the bank deposit guarantee scheme wouldn't be activated, which would save the government money. And also there are limits on the total amount any particular bank is protected under the deposit guarantee scheme. So if you hold money with one of the larger organisations, the question is there enough in the kitty? Nobody knows. So the bottom line is this: the bank deposit guarantee scheme does exist in Australia and could be active when a bank has failed. But the deposit bail-in situation is completely unclear, and I think it's been deliberately left ambiguous. And so I think we should be pressurising our politicians to resurrect that legislation to remove the any other instrument clause, which would then remove the chance of a deposit bail-in. But actually, practically speaking, I think the risk is relatively low, not least because banks are quite well capitalised. And I suspect if one bank was bailed in, then that would pretty much trigger the end of the financial system, insofar that everybody then would go grab their deposits from every other bank in Australia. So practically speaking, I don't think personally deposit bail-in would ever happen in Australia, but who knows? It is a theoretical possibility, a theoretical risk, and one which should be removed. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.